Hey, what's up, guys? Today I wanted to share 5 changes I made that helped me secure more profits from DeFi and yield farming. So, hopefully, these changes could help you develop your own strategies to make more money in this crypto market. And if you're new here, my name is Richard. I'm a yield farmer and investor. If you want to check out my portfolio, I have a playlist here that I update every month. But basically, the plan for this video is to share these 5 different changes, so hopefully you don't make the same mistakes that I made and secure more profits. A lot of people don't realize that if they're yield farming concentrated liquidity pools, if they don't have a proper system in place or knowing what to do when each situation happens, you could lose a lot of money. So the first major change that I want to share with you guys is to set wider ranges. Since the first videos that I've put up on YouTube, I always say I prefer wide ranges, and there's a very good reason behind that. So yes, with wider ranges, I'm going to be earning less APR than what other yield farmers are that are running higher risk tight range strategies. It's not going to look very pretty, right? I show you guys like, let's say 20 to 40 to 50% APR. It's not going to look flashy, but it's what is sustainable to me compared to chasing the APR, trying to get like 100, 150, 200% APR out of these pools. So the APR is less, but what we're gaining instead is we're going to have less impermanent loss. We're going to have more capital gains, less capital losses, and we don't have to worry about like rebalancing and managing our positions as much compared to a very tight range strategy. This is especially true if you guys are not full-time into crypto. I believe most investors should not go full-time crypto unless you have a big enough portfolio. So really, this type of strategy is the best for like 80 to 90% of the people. Let's say I'm yield farming Ethereum to USDC, right? And let me just set my ranges here. Let's say I enter at the current price. And let's say this orange line is my bottom range. If I'm deploying USDC, for example, and I'm trying to stay in range for the next 6 to 12 months, I could look at the weekly chart here. Maybe it's looking like Ethereum might come down a little bit with this like bearish engulfing close here if it happens in the next few days. But at the same time, there's a lot of bullish tailwind. Like for example, the interest rate is coming down. And if we go to the monthly chart, the momentum seems to be swinging up as well. So maybe if I'm not that sure about where the market is going to move, I would set more of a neutral range, right? Maybe the top range is at $7,000 and the bottom range could maybe be around this 50 simple moving average here, which is this orange line. And I could move the bottom range to be around maybe $2,500. You can see the price is kind of trading at the middle of the range right now. If my goal is to capture more APR to cash flow, not really trying to get like the maximum capital gains, then this could be an example range that I could set, right? Again, even if the prices don't move in the way that I expect, for example, if there's a huge negative catalyst, we enter into a bear market, Ethereum drops down to $2,000 or even $1,500, then of course I would be sitting in some US dollar loss, right? But throughout the process, because I'm earning fees and because whatever USDC I put in this pool is slowly getting converted to Ethereum, so I would have a net Ethereum profit here that I could use to yield farm with other strategies or to just wait for price recovery, right? And on the flip side, if Ethereum goes up in value, whatever Ethereum that I deposited in the pool is going to be slowly converted to USDC. I'm going to be in US dollar profit. And again, having a wider range, even though we have less APR, we're going to have more capital gains if prices move up, less capital losses if the prices move down. Because if you guys look into the mechanics behind the concentrated liquidity pools, the tighter the range, the more aggressive the conversion rate, right? So if you want a better conversion rate, then we need to have a wider range. So with these type of pools, it's always like a balancing act between like risk, capital gains, and capital loss on one side, right? And then on the other side, we're trying to get a higher APR. You can't really have both where like you have maximal capital gains with the same position, right? But also really, really high APR. So you kind of have to like pick one or the other or like a point in between. So that's one major change. And sometimes I go even wider than that if my goal is more capital gains. For example, I have a pool open right now. It's from 2,500 all the way to $100,000 on the upper range. And people ask me all the time, is that not too wide? Well, it is really wide because I'm trying to slowly sell my Ethereum on the way up. I don't want my conversion rate to be very aggressive, right? If I believe that Ethereum is going to move up to $7,000, $8,000, or $10,000 in the next few months here, as the interest rate comes down, the altcoin season swings around, then I'm not trying to actually prioritize the fees in this case, right? So it depends on your goals and how you balance with your overall portfolio. Let's say you want to yield farm with only 20, 30% of your portfolio in a tighter range here or a similar range that I've showed you guys, then that could be a good way to do so as well if you hold like spot bags separately, right? Because what happens is if Ethereum goes parabolic, shoots up to like $7,000, for example, then you still have a lot of upside from your spot bag or if you just stake that Ethereum. So that's something to consider. So you got to take your overall portfolio into consideration as well. Same thing with crypto to crypto pairs here. I like to look at the weekly chart or the monthly chart to set my ranges. I don't want the ranges to be too tight, right? If you guys look at most crypto chart, like they're pretty volatile. It doesn't make sense to use a very tight range for volatile pairs. And at the end of the day, most pairs are pretty volatile. And even if they're not, if you guys look at a lot of different token pairs, what happens is like if the token is very stable, not volatile, it's going to only last for a little bit of the time, right? And then it becomes very volatile again, becomes less volatile, and then becomes more volatile again. So if I were to set a range for this Pendle pool, my bottom range might be all the way here at the bottom of the range, right? And then on the top range, this is again Pendle to Ethereum. At the top range here, this could be a price here if I'm trying to basically optimize for APR. I wouldn't really go tighter than this because again, you risk like being out of range. You have to worry about rebalancing and then stuff like that. It's just my personal preference as well. You could technically go tighter, let's say like these two orange lines here. And if you don't mind like Pendle exiting the top of your pool because maybe you hold some Pendle separately, that's also a good way to do so, right? But again, if you're using like the spot bag to basically hedge your upside risk, then you gotta consider that your net APR might balance out to be lower as well, right? Because you're not yield farming with like a larger portion of your portfolio. And the second big change that I made from like 2024 to 2025, I started taking more profits more consistently. So previously when I just got started yield farming in like 2023, 2024, and because during that time, a lot of retail was trading crypto, we were earning a lot of fees on altcoins. And I would always be rolling that fees either to compound into the position or add it to like a newer, higher risk position because the APR was just so high at the time, right? And then when the market dumps, I would also draw down pretty heavily on my portfolio. So my portfolio went up to like 170K, draw all the way down to around like 60K, and then all the way back up to 180K. And then the second time, because I started securing more and more profits, in hindsight, I should have secured more, but the second drawdown would go to $80,000 to $90,000, right? And then because now every single month, I'm securing more and more profits, if a big drawdown on my portfolio does come now, my portfolio would probably draw down less than what I was seeing last year. So that's the key here. When the prices are strong, I like to secure more of my profits. And we can see that, for example, Ethereum's price has been pretty strong recently. Do I believe, based on the monthly chart, that Ethereum is going to go higher? Yes, I do, especially with Bitcoin dominance falling, right? We can see based on the monthly chart, Bitcoin dominance seems to be like starting this downtrend here. But I'm not going to wait for the perfect top to start securing some profits, right? Every single month, I'm selling some of my fees either back into Ethereum, into Bitcoin or stablecoin to take profits on my positions because some of these positions are pretty high risk. And let me show you guys my portfolio right now. For example, Pixel is a smaller cap altcoin. In the last few weeks, it hasn't been doing really well, but now it's just starting to recover. For example, this pool, I was out of range for quite a while, and now it's just popped back into range. But if I want to de-risk here, I could sell some of my Pixel and maybe some of my Ethereum into stablecoins, right? Or if I want more Bitcoin allocation for a longer term hold, where I'm just holding that Bitcoin for like the next 10 to 20 years, then I could use these fees to dollar cost average into Bitcoin as well. So that's the second major change. When the prices are strong, I want to be taking more and more profits. When the prices are weak, I could be compounding more of my fees and maybe using some of the profits I secured like earlier from like the stronger price action to redeploy into new pools. With this strategy, you don't really need to time the market, right? We're just basically reacting based on what the prices do. When the prices are cheap, things are undervalued. We could be compounding, reinvesting more of our fees. And when the prices are really strong, we could be securing more profits. And the third major change is just risk management. I realized like over the last couple of months, I'm a pretty high risk, high reward investor. I'm more comfortable taking on more risks on like different altcoins, for example, MOG or smaller caps like Pixel, right? But it doesn't mean that you should be copying my portfolio because everybody's risk tolerance is different. Your own personal financial situation is very different. Over the last 4 years of my crypto investing, I've basically de-risked all of my earnings from crypto. So these earnings are basically free, right? I've gotten my original cost basis back. So a lot of these altcoins, even though they're higher risk, I'm still holding on to them for the altcoin season. But really, when it comes to risk management, a really good way to think about it is we always want to have a core majors position. For example, Ethereum to USDC, wrap Bitcoin with some USDC in a pool, right? Or Solana, USDC, Ethereum to wrap Bitcoin, stuff like that. That could be like the backbone of your portfolio if you're trying to take less risk. And even if you're trying to take more risk, I personally would not go like 100% into altcoins because if altcoins don't do well, or if there's a black swan event that puts us in a bear market, then your portfolio would be absolutely destroyed, right? One of these core positions like this Ethereum to USDC, I'm not going to touch it and basically like use whatever Ethereum I have into a higher risk play, right? It doesn't matter how cheap like altcoins are. That's my limit. I keep that core blue chip position, keep that risk balance. And again, it depends on you as well as an individual. For example, if you guys are in your 40s, in your 50s, you probably don't want to have too big of an altcoin allocation, right? Because if you're aping into altcoins with like 100% of your net worth and things go wrong, which they do all the time, you're going to lose a big portion of your portfolio. And it could take you like multiple years or 10, 20 years to recover, right? So know how to manage risk, how to balance your portfolio properly. If you want to keep it simple, an example could be like 80 to 90% or even 100% into major cryptos, like for example, Bitcoin, Ethereum, Solana, and some stable coins. And then the rest, you could play around with some altcoins a little bit if you want to. The fourth change that allowed me to gain more profits is actually knowing how to react based on what the prices do, based on what the market condition is. For example, this is a strategy cycling that I use, and this is more beginner friendly. Let's say we're at the middle price range of this market right now, right? Ethereum is like near its previous all-time high, but if we expect the crypto market to grow, the top is probably not near this price point. It could be around like $7,000 to $10,000 or more, right? So maybe if we want to yield farm, then we could use more of our Ethereum in crypto to stable pairs like Ethereum to USDC. But as the market gets overheated, we could shift more into stablecoin strategies, right? For example, providing liquidity for different pools like USDC and USDT, or just straight up lending out your stablecoins. That's also a great way to earn your yield, to secure some profits, rather than chasing the range upwards with this crypto to stable pair. I talk about chasing the range all the time. What it is basically, let's say you're yield farming with a tight range, right? This is what a lot of people do that get into trouble. They basically yield farm with, let's say, this yellow box of range here. When prices move up, they rebalance upwards, locking in some apparent loss, but that's not a big deal until the prices dump, right? When the prices dump, you either have to be willing to earn no yield or very little yield, or you have to rebalance down like this. But what you're essentially doing when you're doing that is when you rebalance, you're buying high. And then when you rebalance down, you're selling low. And then if the prices recover, you miss the pump, right? So this is how you actually end up with less capital than what you started with in like concentrated liquidity pools. That's one of the biggest beginner mistake that I see. What we want to do instead, let's say we have like 25 to 50% in our crypto portfolio. We could use this crypto to stable strategy. When the prices exit the top of our range, we could shift back to this stablecoin strategy, right? And when the prices go back to the middle of the range, we could use crypto to stable again. And then when the prices are really oversold, there's probably a lot of crypto to crypto pairs that are at good entries that you could enter into. And the reason why we use crypto to crypto pools for like when the prices are really cheap is because when the prices bounce back, recovers really hard, then we're not converting a lot of our crypto into stablecoins, right? And then when the prices are back to the middle of the range, we could reduce a portion of the risk in our portfolio back into crypto to stable pools. This is how I've been able to basically have less drawdown on my portfolio while having like a higher high when the prices bounce back. So this strategy is really powerful, guys. And it makes sense if you just think through this, right? And there's more like advanced strategies as well. I won't go into too much details here just because it's a little bit more advanced, but we are doing the same thing. And then in an overheated market, we could use the bear lever where we're basically shorting the market with our concentrated liquidity pool strategy. We could run some pseudo delta neutral strategies as well and a mix of stablecoin strategies. And typically, I'm not putting my whole portfolio into one of these strategies, right? My portfolio would have like a mix of different strategies, but maybe my allocation will shift depending on the price movement. And then in an oversold market, we could go back to this bull lever strategy as well, right? So if you guys want to dig deeper into these more advanced strategies, I do have like a bunch of different strategies that I've mapped out. You'll have access to it in my paid course and community, but I'm not really trying to like heavily promote my course or anything. The only reason why I made it is because a lot of people have been asking me about it, and it does cost me a lot of time and effort to keep like the quality high. So I do need to charge a little bit of money for that. If you're interested in that, just send me a DM on X that you want early access. I'll give you the details and you can decide for yourself if it's worth it or not, right? But I'm not really trying to like shill this program too hard here. It's not for everybody. It's only if you want more help with liquidity pools. And I try to give my best information for free here as well, right? It's just very hard to be like more systematic on YouTube just because the way the algorithm work. I kind of need to mix like the beginner and the advanced strategies to basically keep people interested, right? Anyway, that's the end of my rant. So here's the fifth and a very important change in my opinion is securing a good entry. Depending on your goal for a specific liquidity pools, for example, if we're yield farming Pendle to Ethereum, you can see this green line is actually my entry here. I entered into this pool a couple of weeks back. Is it the perfect entry? Is it the absolute bottom? No, it's not, right? You can see I'm sitting in some slight loss here for my entry, but the loss is very minimal if we enter at a smart price. So this is again Pendle to Ethereum. When we're yield farming these altcoins with Ethereum, I typically like to look at the Ethereum chart because at the end of the day, I want to try to close my positions at an Ethereum profit, right? If I bleed out in Ethereum value when I'm yield farming this pair, then it's not really worth the risk because we're taking more risk on these like smaller cap altcoins. We want to try to get a better return to compensate for that risk, right? So the reason why we need to try to get a good entry is because even if you're wrong here, you're going to be sitting at a smaller loss compared to if you entered all the way up here, right? And let me show you guys this position right now. So initially I went with a tighter range, but I rebalanced to a pretty wide range here because I expect like a bigger move to the upside. I want to capture more capital gains. I talked about it earlier, right? It's always like a balance between fees and capital gains. But this position is actually sitting in a very slight loss, about 10% loss. It doesn't show that because I rebalanced this position. But basically, I started off with 3 Ethereum. Now it's down to 2.763, and then a little bit of fees in this case. So that's not a big deal because I am positioned for altcoin season. And if I'm right, Pendle would likely outpace Ethereum here, and then I could eventually close my position for an Ethereum profit. You can see the APR is not that high, but it's still better than like buying and holding. You can see compared to holding, on this rebalance position here, there's very minimal divergence loss because I went in with a wider range and because the prices have not moved like that much from my initial entry here. But again, even if I'm sitting in a slight loss, it's still much better than if I entered all the way up here and then I have to see like a 50% plus drawdown, right? And even if it keeps dipping here, entering here is still much better than entering back here. Successful investing, again, is about like limiting your downside risk while trying to capture more upside if possible. We're not always successful when it comes to capturing upside. That's why it's very important to try to minimize the downside risk when possible. And one of the ways to do that is to get in at a good entry. And the way I like to look at it is that if a pair is crabbing sideways here, we want to basically try to get in at this horizontal zone of support. Again, it doesn't have to be perfect. We just want to get in around here rather than all the way up here when Pendle is overvalued to Ethereum, right? That's my preferred method. And then when the prices swing back up, I could consider to exit my position to de-risk completely as well to capture that swing upward. And again, I'm not trying to basically time the market too much. If the prices go down, I could compound more of my fees to basically drag down my entry, which also makes it more likely for me to close this position in a profit. But if it's a trending pair, the entry becomes a little bit more tricky. For example, I've entered into this Athena to Ethereum pair. What I like to do instead on a trending pair is I enter into like a key zone of moving average support. So I entered into this a few weeks back as well. You can see I did not get the perfect entry, right? You rarely will because we can never know like, okay, what the price is actually going to do in the future. But I did wait for like a small retrace to try to get a better entry on this 20-day exponential moving average here. You can see the better entry probably is this like yellow trend line, which is a 50 period simple moving average. But you can see the main idea here is we want to try our best to get the best entry. And because we can't see the future, it doesn't mean that we will always have a good entry, right? The prices could keep going down. Like for example, you could be here and then you're convinced that the prices are basically bottom out, but then the price dip further down, right? So we need to know how to react as well. But again, entering here is still much, much better than like entering all the way up here, right? This is how you guys can lose a lot of money when you guys are yield farming altcoin to Ethereum pairs. If you enter at a very high price, especially with a tighter range, it doesn't matter if your fees are very high. Chances are if the capital loss is much greater, you're going to be losing a lot of money, right? That's why we want to enter into a good price. Even if the prices draw down, the losses would be less than if you enter at a very high price. So I hope that makes sense, guys. So just a quick summary here. There's 5 changes that I made. And a lot of these I came up with myself because what I was learning in 2024 wasn't really working, right? Like the squeezing the range and stuff like that, trying to get a higher APR, it just doesn't work long term. So the first change I made was I set wider ranges, mainly based on the weekly and the monthly chart. I try to stay in range for the next 6 to 12 months. The second is I consistently take profits with my fees and sometimes exit out of positions when it's favorable as well, rather than constantly rolling my profits into the next play. The third is risk management. I always have a core position that I will not risk into like more speculative investments, right? So always have a core position that is backing up your portfolio. The fourth is knowing how to react based on what the prices do. The fifth is try to get a good entry if possible. That's going to limit your downside risk while giving you more upside in the process. And if you want to learn more about yield farming, be sure to check out my other videos. Thank you once again for watching. I'll catch you next time.